welcome to Moneycontrol. You've tuned into IPO Watch and I'm your host Nickey Mirchandani. Well, today we are here to talk about Credo brand marketing. It hits yet another IPO which hits the primary market. Of course, planning to raise around 550 odd crore OFS only. But we are here to dissect more about the company, the financials, the strategy, the unique positioning and what's next. But to take the discussion forward, we're being joined by Kushal there, who is the CMD, and of course, also we have Rasik Mittal, who is the CFO of the company. So I'm going to quickly start off with you, Kamal Khushlani ji. How do you first? Let's talk about your brand put together. What is it all about? And clients and your OFS only. Why this OFS only at this point of time?
So I'll start off with the brand first. So I don't know if you're aware of the meaning of this word. It's a Hindi word, Mufti. It's actually a term used by all our armed forces whenever they're not in uniform. Like the police would say that, sir, kal hame raid marne jana hai, uniform mein aana hai, Mufti mein aana hai. So technically, we're all in Mufti right now, including yourself, though we are not into women's wear. But whenever you're out of uniform, you're in Mufti. So that's how the brand was actually born, because at that time, the type of clothing that we wanted to make for the consumers was very, very different as compared to what other brands were doing. So chose to call it Mufti and launch it as a concept and give it a tagline saying anything else is a uniform, meaning that most of the brands were making clothing we were making clothing that was very, very different as compared to them, and we stood out. So hence we called the brand name Mufti, and we are where we are today. We continue to redefine clothing for men, which is casual, creative, bold, and expressive. And I'll come to the OFS part. The thing is that ever since the beginning, the history of our journey, the company has always grown profitably and has been able to, generate enough cash to not only achieve the growth plans that we have, but also has been a company that's been able to pay off healthy dividends to its shareholders. And we intend to continue doing that. So two things. A, we have some angel investors who've been with us for more than 15, 16, almost 17 years. So A, to provide an exit to them, and B, also to get more visibility for the brand. That certainly will help propel the brand further and could help the growth of the brand. Both these reasons put together prompted us to do the IPO, and of course, that's why it's an OFS, because the company does not really need funds, even for the plans we have going forward.
Right, that seems like quite a fair statement there. But to know more about the dynamics, sir, I'd like to understand about your revenue performance in that case for the last 5 years. Just the CAGR, if one was supposed to look at, it's grown at 5% as compared to the peers' average of roughly, say, a growth of 16% and industry average of 8%. Going forward, the retail industry is expected to grow in by 10%, at least for the next 5 years or so, by FY27. What's your growth trajectory out there? You think you'd be able to outperform the industry by a huge margin? How is it?
Yes, we in the 5 years we've grown at a CAGR of 10%. However, in the last 3 years, we've grown at a CAGR of 42%. But the point I'd like to make is that we made some big changes in our brand, in terms of our brand identity, our retail identity, and our merchandise architecture. And all these changes were made just prior to COVID, starting from 2018 until 2020. So all the changes that we made have begun to bear fruits, as you can see from the results that we have shown now. And going forward, the industry, as per the industry report, the industry is likely to grow at 21%, out of which the organized sector is likely to grow even higher, and the men's branded sector is likely to grow at a rate of 28.9 odd percent. And whatever we have done, there are a lot of, COVID gave everyone an opportunity to course correct itself and kind of bring in as many operational efficiencies as you could, because there was a period where there was a complete lull and you could completely focus on every nook and corner in your company and improve whatever efficiency that you could, which is what we have done. And here we are. And We have, opened a lot of stores even during COVID, thankfully, because we were cash rich. And we intend to continue doing that. And I'm sure we'll be able to maintain the rate of growth that the company has shown.
So this revenue CAGR that I suggested was between the period of FY 2017 to 2023. That's the period that we're looking at, and the numbers that we've compared. Of course, one question that we really wanted to understand is 10% is the growth rate for the retail industry, right? By FY 27, at least that's what the outlook looks like. You think you'd be able to outperform that number?
So, in the first 6 months of this year, we've opened 31 new stores. And in the last year, we opened 52 new stores net of all, any closures. And prior to that, also historically, we have been doing that. And also, we've seen a healthy growth rate across same points of sale.
Right.
So, both of that put together, if we had 404 stores as of 30th September 2023, if you reduce the 31 and reduce the 52, you could see where we are and how we have grown. So we intend to grow and continue doing what we've already demonstrated. That is by opening new stores and by continuing to grow across same points of sale. So I think we should be able to maintain doing what we've been doing so far.
Sustain your revenue performance in that case. Also, being a mid-premium to premium player, Mufti has focused on tier 2 and tier 3 towns for expansion, occupies a smaller share of 24% in metros. Do you intend to diversify? Do you intend to change that mix, or the business remains as is?
Want me to take that?
Yes. Yeah, you can take that.
So, sorry, let me take that for you. What happens is that when you look at it that way, it appears that we have a smaller share of 24% in the metros, but it's actually not like that. We are there in the mid premium to premium space.
Right.
Uh, Everywhere in the country, starting from metros to tier 1, tier 2, tier 3 towns. We run stores across all types of towns, and we are present in all important malls and high streets and some airports also. So, wherever there is a demand for mid premium to premium casual wear for men, we ensure that we are present over there, whether it is through the MBO channel, large format stores, department stores, or through our own EBOs, and of course also on the online channel. So we have a good demand across all types of cities.
Do you intend to change that mix anytime soon?
Well, I don't. I think India will not allow us to change that because the rate at which India has been showing an appetite for growth across all types of towns, smaller towns opening new MBOs also
So
smaller.
where is the growth typically higher?
It's coming across all types of towns.
Incrementally?
Yes, across all types of towns. In fact, across all kinds of what do you say channels. But however, EBOs is something that is within very much within our control, and that is what will within our control, and that is expected to grow at an even higher pace. But we are seeing growth across all kinds of towns. To illustrate that, metros are expanding into fringe markets. Tier 1, Tier 2 is doing the same. Some Tier 3 towns are emerging as EBO markets, and Tier 2 towns are expanding horizontally. There's enough opportunity that India is showing horizontally and vertically both.
Okay, so I'm assuming that the mix remains the same in that case.
Yes,
And given that the
The mix may change by 1 or 2%. That's about it.
and
Not
the
much.
1 or 2% shift will go where?
Anyway, it's
Okay, so not much dynamic changes out there. Let's get on to your the model of the company. How different are you as compared to other players in terms of asset light model that you have, where you outsource manufacturing, do the designing in house? Tell us how different is this model as compared to other players. What is your cutting edge amidst all of this?
Truly speaking, cutting edge is in terms of product, the type of product that we make, just like I said, starting from the inception of the brand, which happened because of a gap we saw in the industry for men. And that's how the brand was born, hence the name Mufti. We continue to redefine clothing for men. And in fact, I will urge the viewers to actually visit the stores and touch and feel the product, because until and unless you do that,
You're also wearing
Nickey,
Mufti, right?
Yes.
always. So unless you touch and feel the product, you will not know how we are different from the others. So product is where we provide the cutting edge, and the other part is how we run our business. See, in our business, the most important thing is to being able to liquidate everything you produce profitably. That's the key to running our business. And historically, that is something we have been doing, and we should be able to continue doing that.
So your quality is one differentiating factor.
Design and
That's
quality.
design and
Value
quality,
proposition.
the value proposition. That's where you will distinguish. Is there more to it?
Well, the value proposition is very sharp for the consumer for the type of products that we offer in the casual wear space is bold, expressive clothing for someone who wants to stand out and express his personality and not for someone who wants to blend into the crowd. So that and the way we will serve our consumers is the way we intend to win like we have done so far.
Different fabrics also we come out with means.
All the time.
Yeah.
Yeah.
Mr. Mittalji, do you want to add to it in terms of fabric? You mean product diversification that we're looking at that can act as a distinguishing factor of your company vis-a-vis other players?
I think this is Kamal sir's domain. So I think he'll have to take this. Yeah.
No, as we speak, we are adding, we're working on categories like footwear, belts, boxers, socks, etc. But these are to complete the, offering, the basket of the offering to our consumers in our lifestyle. And because our consumers come back to us and often seek more clothing from us and more accessories, which is what we intend to get into. But like I said, to complete the basket of offerings.
All right. I'd also want to understand more about how does the company sells the products and essentially gets that revenue as a percent of their mix. It sells through website and of course third-party e-commerce marketplaces, right? Where more or less 50% of your revenues come from that. Do you intend to change that mix going forward? Are you going to coming up? Are you planning to come up with more physical stores? Tell us more about it.
So, like I said, we opened 31 new stores in the first 6 months of this year, 52 next year, and we intend to continue opening stores at the same.
You're not really very audible in that
I'm
case.
so sorry. I said, like I mentioned, we opened 31 new stores in the first 6 months of this year and 52 in the last financial year. We intend to continue our physical stores at the same rate. And as far as the e-commerce is concerned, it's between 5 to 10% of our revenue. And that ranges in time. And even and as of today, we use this channel to liquidate our old season merchandise. See, we have always grown the company through the profitability lens.
Right.
And as on date, the consumer in the online channel is lured by discounts.
Right.
So that's a discount-led business.
Right.
So whatever we have sold until end of season sale, whatever is left over post that is what we liquidate through the e-commerce channel. And whatever we provide to our consumers, whether it's in the e-commerce channel, whether it's my factory outlets, whether it's the EBOs, whether it's the MBO, LFS, wherever it may be, we ensure that the customer gets the same product that we have promised and he gets it at the same price across all points of sale. So that's how we intend to grow this business, and that's an ecosystem that's going to go forward, moving in this direction. However, as in the West, some of the markets have developed into more being conducive for full price purchases. At that time, we were working on our website, and as and when the customer acquisition cost there comes at a level and where the consumer is ready for full price sales, we'll be ready for that.
Isn't the sales through website more cost effective and more margin accretive as compared to a physical store? You intend to expand your physical store presence too. How will the mix move going forward?
See, the mix could move more towards website, but that will be a function of.
From 50% you intend
It's
to
very
go by?
difficult to say that percentage today, because what happens is that as and when the consumer becomes ready for full price purchases is when the business is going to move there. See, we are a brand, we are a brick and mortar brand providing fashion to the consumer. And like I said, there's a different consumer there available in the online space and offline space today.
Right.
The online consumer is lured just by discounts
Right.
today. So
Right.
therefore, we use this as it's part of our ecosystem to clear the OSM.
Okay. So in that case, given that you're supposed to give those particular discounts at a particular range, where the margin accretiveness is more in that case? Is it through the website or is it through the physical stores? How can one look at it?
Businesses are EBO and MBO, the main businesses, we make similar kind of margins. Of course, we make lower margins when we do business with e-commerce partners, and slightly higher when we do it with our website. But if you look at the customer acquisition cost that we have to pay to acquire the customer, it more or less comes to similar points today. That's what I mean, that as and when the consumer gets ready for full price purchases, as and when the market evolves to that, we will move in that direction.
Point well taken. Well, let's talk about your EBITDA margin in that case. There is a significant improvement that we have seen when it comes to the financials. 19% in FY21. It grows to more than 33% in FY23. Help us understand what the expansion, what really is the rationale behind the expansion, and how sustainable are these numbers going forward?
Sustainable because that is the first full year after COVID.
Normal year.
No, first normal year after COVID.
Right.
FY21 was affected by COVID, so the company couldn't perform to the fullest potential. FY23 was the first full year for being a normal year to the full potential, and these margins are absolutely sustainable going forward also.
So when you talk of the difference,
what are the growth, beg your pardon, what are the growth drivers per se? 33% is a sustainable level. And what are the growth drivers that you think can help us stay around that number?
So the company will, as Kamal has said, we will be able to do more business by opening new stores, and even in the same store, basically existing stores basically.
see what has happened, there are a lot of operational efficiencies that have been brought into the business during this period of COVID, as I mentioned earlier. And prior to that, there are big changes that we made in the brand in terms of brand identity, retail identity, merchandise architecture. And all that put together, as I mentioned earlier, is what is bearing fruits today. So there are a lot of operational efficiencies that came in. We managed to save on account of manpower, on account of the way we structured the business, etc. So these are margins that certainly we had a first normal year last year post COVID. So these we hope we should be able to sustain going forward.
Could you, since we are talking about margins, could you give us a split of how your product-wise margin contribution really works, just to understand which of the business or which of the segment per se is more margin accretive?
So, for us, more or less in that sense, even as per the industry report, we have a very balanced mix in the product portfolio that we offer to the consumer, and our sales are almost half and half in top wear and bottom wear.
Right.
So for us, both are products that are differentiated from what's already available in the market, and we make similar margins in both.
So none of them, one of them, which is perhaps no margin difference.
You could say the margin is slightly lower, but otherwise, that's the case for everyone in the industry.
That's a very small portion.
Yeah.
So Q3 you mean is a seasonally weak quarter for the company, if I may put it that way?
It's not like that. It's in fact depending on when the season comes in, festival season. So sometimes your Q3 becomes slightly stronger or weaker due to that.
So with the demand that is shaping up on ground, tell us more about that. Do you think second half now looks better than the first half? Tell us more about the key trends across categories that you're witnessing.
So typically, if you look at the first quarter is a quarter which is lower. The third quarter is again a quarter because it's a seasonal business. So there's peaking in Q2 and Q4, which is what you typically observe in our industry.
Okay.
So that's how it is. However, we are tied down and cannot put in numbers or in perspective as to how we are currently looking. There is something which is out in the RHP, and that's where we are. But I can say there's a healthy rate of growth, and by the end of the year, we should be able to normalize.
Okay, so is your second half looking better than the first half? Back to square one.
See, the first season definitely for the entire industry was a muted one, and it's a more hopeful season, this one so far during Diwali, and hopefully we'll be able to annualize it and finish at the level where we intend to.
That's still doesn't answer my question, does it?
So I'm really tight down, I cannot make forward-looking statements, Nickey. Otherwise, we would
You
have been
said
happy
the first
to.
half is tepid. I mean, I'm not asking you to put a number. I'm just asking you to give us a sense of direction, right? I'm not pegging you down to a number. It's just the second half versus first half. It's just a basic improvement in demand. What are the conditions looking like?
See, last year, the first half was better than the second half.
Okay.
And this year seems to be a flip of that.
Okay. And why is that we're looking at?
Depends on seasons. See, in the fashion business, some seasons are slightly better, some seasons are slightly worse. But these slightly better does not mean, drastically here or there. What happens is there's a shift of a couple of percentage points here or there. That's what happens. So it depends on how you plan your business.
So 500 crore was the figure roughly in FY23. What kind of run rate can we look at when we talk about 500 crore? Is when do you plan to hit the milestone of 1000 odd crore? Is it doable by FY27? Not asking you the near-term projections. Just a 1000 crore mark is doable by when?
Was first quarter this year versus first quarter last year.
Yeah. So typically Q1 is generally 18 to 20% of the annual revenue historically. So according to that means Q1 numbers are there in the RHP, can be worked out.
Extrapolated.
Yeah, extrapolated. And 1000 crores by when?
I don't think we can talk about that.
You're looking at the projection. Okay, I'm not going to push you more than that. Okay, in that case, let's talk about your product range that you have to offer, and of course, what do you intend your plans going forward, both in terms of organic as well as inorganic expansion? How are you looking at it?
So, like I mentioned earlier, we opened 52 stores last year, new stores. That's the inorganic expansion. We opened 31 stores this year in the first 6 months. That's again inorganic expansion. So if we had 404 stores as of 30th September, if you can reduce 31 stores out of that, you can probably reduce another 52 out of that and see where we were. And last year was the first normalized year. So basis that is how we are going to keep growing even going forward. You could get some number there, and there has been a healthy rate of growth that we have been seeing across same points of sale. So in organic and inorganic growth put together, if you calculate that number, is how you can extrapolate, and that we shall continue doing.
Kamalji, just feels like a dodging of questions out there, but
You can really back calculate. I said 404 and 31 new stores in 6 months. So you can reach the 373 stores that we were as of 31st March 2023. Reduce 52 stores out of that. We were at 321 in the beginning of the first normal year. Add the inorganic growth to that, to whatever that was, and add some healthy organic growth to that. That's the rate at which we can grow. Beyond that, I'm really tied down to be able to say anything.
So just to put this thing, means FY23 we were at 373 stores.
Right.
And 30th September we were 404 stores, 31 stores. That would come to around maybe 14-15% additional growth in stores. Accordingly, last year 373 means that's what Kamal is saying. It's not trying to dodge. Basically, this is how the number is coming to basically.
All right, gentlemen, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation with us, and wishing you all the luck for your bidding, which opens up, of course, today. That's the management, and stay tuned in.